Welcome to my channel. I'm the covered call guy, and I'm trying to create a $120,000 passive income portfolio using only covered call ETFs. Right now, it yields about 100. I'm sorry, not 172. I wish. Right now, it yields $72,000 a year, $6,000 a month, about $1,400 a week, and about $200 per day. I will be updating this at the end of every month, so in about 2.5 weeks. Hopefully, I would have crossed $75,000 a year. Legal disclaimer before we start this video: this content is for informational and educational purpose only and should never be considered financial investment or tax advice because I am not a licensed financial advisor, investment professional, or tax expert. All opinions expressed are my own and may be inaccurate or incomplete or just flat out wrong. Investing and trading involves significant risks, including the possible loss of principal. So please always conduct your own due diligence and consult with a qualified licensed professional before making any financial or investment decisions. Remember, I am just some random idiot you found on YouTube, and I could be completely wrong. Now let's get started with today's video. It is a very, very important one, especially if you're new and you found my channel. Welcome. Thank you. I hope you subscribe. This is going to be a fun channel on my journey to $120,000 in passive income per year. I will try to only be using covered call ETFs, but it seems like closed-end funds are looking pretty good right now, so I might have to change my YouTube channel name to CEF/CCETF Investor. Anyways, let's get started, right? I want to really talk about how long-term thinking beats short-term noise, right? This mindset will lead to institutional wealth, right? That's how it's built. It's built on consistency, not listening to what other people say, not being scared because other people are panicking, right? A lot of people will create noise around you. You just have to drown it out. Really, right? This week wasn't a good week. I mean, the market didn't really jump up and stay up, right? But I still bought. And right now I'm building up my Maggie position, ticker MAGY, right? It's getting beat down right now, like pretty much of the entire market. But I bought a little over $4,000 worth this week of Maggie. It is approximately about anywhere from depending on the price, right? Anywhere from $50,000 to $55,000 in total value. I'm trying to build it out to $150,000 to $175,000. I don't care. I love it when the market is red. I don't care when the market is red. I don't. I buy. When the market is red, I buy. I do not care what other people think, what other people feel. You know, that is just noise. I don't listen to it. I do not listen to it. I posted a post of my screenshot, by the way. I don't know if that counts as showing my buys and whatnot. They're not fake. I don't know how to use Photoshop. It's real. And if you want to see my year to date, I probably do a screenshot year to date from when I started to how much I have now. Let me know in the comments if that's okay with you guys. Or you're going to say, oh, that's fake or Photoshop. If that's the case, then I'm going to have to figure something out with a editor to show my portfolio. But yeah, I plan to be as transparent as possible. For those who are new, found this channel, found this video, I am trying to be as transparent as possible. I will never make you pay for a Patreon. I don't have a Patreon. I don't have no Discord. Yeah, I'm going to be showing everything as much as I can. I have to figure out how to blur out personal information. That's all. I'll get to it, though. Anyways, let's get started. All right, the goal and mechanicism, right? The goal, most obsess over daily moves. Your goal is different, right? We turn volatility into an income stream. Instead of fearing the chop, you monetize it, right? We should embrace red days. We should embrace choppy days, right? The mechanicism, traditional cover calls act like a ceiling, right? Trading all upside. I shouldn't say all there. That was the wrong word. Trading most or some upside for income, right? And I'm going to use QQQI as an example, right? QQI is a graduated ramp. right? It harvests income during modest rallies, but keeps the door open for upside when the market runs. So I kind of contradict myself here. Well, if I shouldn't have put all. I mean, when I was thinking, I was all cups upside, but for most or some upside. And we're going to be using QQI as an example in this video. Alright, anatomy of market noise. When I say market noise, I'm sure most of you guys know, like I explained it. But for those who are new or just found my channel and just found this video, what do I mean by market noise, right? Market noise is the erratic fluctuation driven by transient factors, right? Earnings miss, data releases, and shift in the sentiment. But today, the loudest market noise comes from social media and the panic of other people. If you hang around social media for too long, too much, if you have multiple social media app, which I truly believe you shouldn't be, especially if you're a subscriber, you're a supporter of this channel, lock in. All right, I'm telling you, lock in. If you are in accumulation phase as I am, we need to lock in. The only time you should be on social media is to catch up on financial news. Obviously, you want to be integrated with what's going on, right? Because I'm not going to say the more you know, the better in this sense. Maybe like the less you know is actually better, right? But staying in tune, sure. But if you're just doing it to doom scroll, you're wasting time. Lock in. Right? So their fear triggers your fight or flight response. But for you, the income investor, this volatility is the raw material of production. And what I mean by that is we sell on that fear. We buy the fear. That's how us income investors make the most money. Okay? When the premiums are at its highest, that's how we make our money. We embrace the fear. We embrace the choppy markets. We embrace the red days. That is how we make our money. That is where the sweet spot is for us cover call investors, income investors. Right? And it's just a quote from the behavioral finance principle. The pain of a loss is psychologically twice as powerful as the pleasure of an equivalent gain. All right? Basically, when you lose, it feels a lot harder and it feels like the knife is deeper than when you win. You know, when you see those green days, you're like, oh yes, and then you kind of whatever put the phone away. But when the market is going down, you are constantly watching it, right? Oh my God, how much is it gonna go down this time? And then the next 5-10 minutes, you're looking at the phone again. If you're not looking to buy to use the dry powder, which you should always have, right? At least some dry powder. Don't use it all. You should be looking at the price to be like, okay, maybe I can nibble some more. Nibble some more. I'm speaking, obviously, if you have solid quality cover call ETFs, income ETFs. Okay, I'm not talking about those 30, 40, 50, 60% yields. I'm talking about those 8 to 15% yields. Those and certain, some of them are not always so great, but I'm talking about, if you're on this channel, I always talk about the GPIX, GPIQ, NEOS, right? My growth, QDevo, if you own the 5%ers, Divo, right? The solid, well-known, like JEPI, JEPQ, right? The solid cover call ETFs. No matter what the market's doing, they make you the money. And their number one rule, they don't lose money. Alright? QQI provides behavioral alpha by offering tangible, realized returns every single month, reducing the urge to capitulate. Alright? That's what a lot of people do, is they just like they fold when these red days happen. And I made a post. Like I said, I made a post. I took some screenshots. I buy on the red days. I buy every week. Actually, I buy every week. Maybe if you want, I'll show my post every single week. If that's something you guys like, I will create a post and I will do it. I could even make a video about it if that's what you want. Whatever the subscribers want, the viewers want, leave it in the comments. That's what I'll do. I'm a man of my words. I'm not here to BS. This channel is I'm trying to be as transparent as I can be. Obviously, I'm not just gonna be showing my I own Bitcoin. I'm not gonna show my freaking account. I think that's a little too risky. I'm not that tech savvy, so I try to. I don't want to dox or expose myself like that, but as much as I can. All right, income as a compounding engine, right? This is the core thesis. While price appreciation is theoretical, cash distribution are liquid and real. When you reinvest these distributions, especially during downturns, you create an automatic dollar cost averaging machine. You accumulate more shares at lower price, accelerating the recovery when market turns. Maybe I could take a screenshot of my year to date, and you would see it just shoots up. I want to show you guys proof if that's what you're okay if that's what your guys are okay with screenshots. I have no problem with that. Just let me know in the comments. I'm very open. No BS. No. I don't care about sponsorship on this video. Right? You guys are my sponsorship. You guys subscribing, liking, leaving comments. That's my sponsorship. That's all I really care about. As the channel grows, forgive me. I may not be able to reply to hundreds of comments as the channel grows. So forgive me on that, especially to my day one supporters. I apologize. All right, structural analysis of QQI, because I think QQQI is one of the best ETFs in terms of the Qs. I really love it. I love NEOs in general. I try not to be biased, but when we do comparisons, when we use income ETFs as an example, I have to choose NEOs, right? I mean, you guys go ahead and give me another cover call fund I can use an example of, but NEOs is just that gold standard right now, and hopefully maybe going to 2026 they stay the gold standard. But if they don't, I will use another one as an example. I'm not trying to be biased here. All right, let's look at QQI, right? The underlying exposure. QQI tracks the Nasdaq 100, which is the NDX. It owns the actual equity. It owns the actual equity. Oof. In ensuring direct exposure to long-term innovation growth of capital, growth of companies like Apple and Microsoft. Active options strategy. It uses a call spread strategy. Short calls generate income while long calls capture upside. This creates the ramp profile that I'm talking about. Ramp or ladder effect. It just depends on how you want to use these terms. But that's what I mean by the ramp profile, right? So it has the long call to capture upside, which is the NAV, right? Keeps your NAV afloat. And the short calls to generate that income, that payout, that 13 to 15% payout. And of course, what they're known for, tax efficiency, right? Utilize Section 1256 contracts and tax loss harvesting to optimize your after-tax yield. So they lose money on purpose at times, not always, at times. All right, the call spread advantage, right? So legacy strategies like QYLD, these sell at the money calls, right? If Nasdaq rallies 2% tomorrow, you get zero participation. This capped upside leads to NAV erosion over time. Versus the QQI innovation. QQI sells calls for income but buys higher strike calls. If the market melts up, the long call kicks in. Since inception, it has captured about 70 to 85% of the upside. That is great. And remember, the trade-off is you give up the upside. And look at that, it's still captured at least 70 to 85% of the upside since inception. You're getting both the upside and income. It's so good, right? And remember the noise, typically for those who are new that just found my channel, this video, and trying to get into income investing, the noise you're gonna hear, especially on Reddit or whatever, social media form that you use, they're always gonna talk about these legacy strategies. That's what they use to kind of like keep you down and away from it. They always talk about the ones that doesn't work out. They always use the one that doesn't work out as examples instead of using the ones that have been consistently performing well. And then they're gonna go, what? You only captured 70 to 85% of the upside? Man, if you just bought growth, you would have done 100%. But I'm trying to live off this. I'm trying to actually use the money, right? They never talk about that either. So just beware of the noises around you. Right, tax efficiency, section 1256. Let's just talk about it real quick. Right, QQI utilize NDX index options classified as section 1256 contract. This gives you a massive advantage. Right, 60% long-term capital gains, maxed at 20% tax, while 40% short-term capital gains is ordinary income. Plus, active managers use return of capital (ROC) in 2024. About 95.8% of distribution were ROC, meaning they were largely tax deferred. Okay, great trade-off here. You're winning. We're winning on all fronts. All right, verifying the math. For those who are new, I like to do my simulations. I like to do my illustrations. I like to do my scenarios. Right, I like to do model testing, stress testing, and this is one. All right, scenario here. We start with $5,000 already invested. We add $100 a week, and of course we gotta assume about a 13.5% annual yield. It's my conservative base case, right? So year 2, invested capital, you have $15,400. Portfolio value, you have about 1872,720. Annual income, about 2,500. By year 4, you have about 25,000 invested. 37,000 as your portfolio value, and almost $5,000 as annual passive income. Year 6, invested capital, 36,000, portfolio value, 61,000, annual income, 8,200. Year 8, invested capital, 46,000, portfolio value, 94,000, annual passive income, $12,600 a year. Right? By year 8, your passive income is doubled your annual contribution. I bet they don't talk about this, right? The noise, the people who create the noise, they don't talk about this. And that is just starting with $5,000 and adding $100 a week. I know you guys, yes you, I know you guys can do more than $100 a week. It's the mindset that you guys have. If you tell yourself I can't or it's too much, then you won't, and it is too much. But if you tell yourself I'm starting with $100 a week for this entire year, but next year I'm gonna double it or triple it, with that mindset, you will do it. It's all noise. Ignore the noise. If you tell yourself you can't, then you can't. It's really that easy. If you tell yourself all right, this job I'm getting $15 an hour, but next year I'm gonna find a job paying $18 or $20 an hour. Or you shoot higher, $25 an hour. And then by year 3, 4, or 5, you're making anywhere from 25 to 35 or even 40. It's that type of mindset. If you only say $100 a week and that's all I can do, then that's literally all you can do because you box yourself in. It's the same way with a job, same way with how you want to make more money. It's the same mindset. And in that sense, you're creating your own noise. And you don't need anybody else to beat you down. You've already beaten yourself down. All right, sensitivity analysis, right? Starting with an investment of 5,000. This is where we see, right? So by the end of year 8, if we enter a bear market or the year was not good, right? The investing period was not good. Sure, bear market, negative 2% NAV at a 50% yield. You still have about $90,000, right? And then the base case we have was the 94,000, right? Flat NAV, 13.5% yield, right? Right here. And then, of course, in the bull market, if the market has just been doing well year after year after year, right? Plus 3% NAV, 12% yield, $108,000. Even in a stagnant bear market, the portfolio nearly doubles due to accumulation. Only you hold yourself back. Whether you create your own noise or you listen to the noise of others. I see it a lot. When I do my due diligence and I do my deep dives, I see it a lot. And I really do feel bad for the new investors because they don't know any better. A lot of people will go ahead and echo chamber the noise, and it just gets louder and louder, louder, and it drowns out any actual good information. And as a new investor, they fall into that pit. Right? So, especially for those who are new subscribers and new investors, I hope this video really does open your mindset, opens your third eye, and kind of give you that expanded vision. And we talk about countering the doesn't beat growth narrative, right? They always use that this doesn't beat growth. Why would you invest for that? Just buy growth. But they never talk about the 2022 case study. Critics say just buy SPY, but in 2022, SPY lost almost 20%. And the income proxy of SPY was effectively flat at negative 3%. To recover from an 18% loss, you need a 22% gain. SPY investors started the recovery from a much higher base. Or the other side, we win by not losing. Most investors don't experience index returns, they experience behavioral adjusted returns. By avoiding the deep drawdowns, you preserve your compounding engine. And what I say, reinvest, go buy on the red days, go buy on the dips, right? You should always have dry powder for these days. Of course, I gotta talk about the sell share fallacy. Sell shares, man. Who wants to do that? I don't want to sell a single share at all. This channel is all about long-term growth, long-term compounding, long-term wealth generation. All right, so people say just sell shares for income. That to me is mathematically dangerous. If you sell shares during a crash like 2022 to pay bills, you lock in losses forever. It is a reverse dollar cost averaging. With QQI, you spend that cash distribution and never touch the principal. You never have to sell a share at the bottom. That is one of the first rule too. Don't ever disturb the principal or touch it if you absolutely do not need to. All right, strategic implication and risk, right? We always talk about the accumulators. Use it as an aggressive compounding engine, right? It's tax deferred growth. For retirees, use it as a shield. Live on a 12% yield, reinvest 4% to fight inflation, which you should always. It's not just for retirees, but for an accumulation phase too. I mean, you want to just accumulation phase. You should be reinvesting 100% of it, plus more, if possible. All right, the risk capped upside, you lag in a vertical bull market. That is the trade-off. That is almost impossible to not trade off because we are investing for income. If you want growth, go for growth. I don't know what to say, I'm not trying to accumulate for 30, 40 years and live my life at 60. That's not something I want. Volatility regime, lower volatility equals lower premium, right? Track the VIX. The VIX is all about the fear. Bigger the fear, more fear in the market, we get higher premiums, we get higher payout. NAV erosion, if distribution is over or more than total return, NAV erosion. That's easy, right? Simple as that. I don't know how to explain it that easy, all right? You see the NAV going down while the market is up, NAV erosion. My verdict here, I'm pretty sure my math is verified. You can verify it, right? The $100 a week strategy is a formidable compounding engine. And I want to say you should be able to do $100 a week. Unless, of course, there are life situations, but I'm saying in general, most of us, I know all of you guys watching this video can. It's just a matter of your mindset. Right? Structurally superior, Section 1256 and Rock provide unmatched tax alpha. Psychological, sustainable, tangible cash flow beats theoretical paper gains. I don't care about your net worth. I care about your cash flow. Don't don't show me what the digits is on your brokerage account. Show me how much you're getting paid out every week or month from your brokerage account. That's all that matters. I need to pay bills, right? I need to live. I need to buy food. Insurance costs money. Having some fun in life costs money. Consistency wins. Don't let the noise shake you out. If it doesn't shake someone like me out, why should it shake someone like you out? I know you can do better. Don't be on these social media apps that literally try to manipulate you into selling. Because that's probably what they want you to do. The more pressure they can put on you, and then you go ahead and fold, and then you go and talk about it, someone else folds, they're probably buying up the cheap shares. For real. That's the video today, you know. I know it's been a tough week, a tough month, but don't let these people on social media shake you out your own thesis, right? You hold quality cover called stocks or ETF, continue to buy. And I'm true to my words. I already created a post showing my buys. I didn't do it every single week just because I feel like I'm not sure if people just want screenshots or they're okay with screenshots, but I'm gonna start probably consistently posting screenshots just to let people know I'm buying. I don't make these videos just to make videos. I make this video because I'm documenting my journey, true to my word, as transparent as possible. All right, thanks for watching, guys. Comment, like, subscribe for more insights. Subscribe for more of my little informational, educational rants. I appreciate all of you guys for watching and subscribing and leaving comments. I really do. No BS, no fluff. I really appreciate all of you guys. I mean that. Thanks for watching. Stay tuned. Catch you guys on the next.